The global financial landscape is undergoing profound structural shifts, and most people don't yet realize how deeply these changes will alter the way wealth, value, and security are defined in the years ahead. When we talk about inflation, debt, or geopolitical tensions, we often treat them as separate stories, individual news events. But in truth, they are interconnected forces shaping a new economic order. Understanding this web of connections is essential because the rules that govern the last few decades are breaking down, and the traditional safe havens that once worked are now evolving in meaning and importance. To grasp what's happening, we first need to understand that the economy doesn't move randomly. It moves in cycles. Cycles of credit expansion and contraction, of trust and fear, of rising and falling power. Right now we are in the late stage of one of those long-term debt cycles. For decades, governments, businesses, and individuals have borrowed more than they produced. Debt was cheap, money was easy, and central banks were there to ensure the machine kept running smoothly. But that machine runs on confidence, and confidence is now eroding. When inflation began to rise sharply after years of low interest rates and money printing, many assumed it would be temporary. Policymakers called it transitory. But inflation isn't just the product of short-term disruptions. It's the symptom of deeper imbalances. The world's monetary system, built on fiat currency and credit expansion, has reached a point where creating more debt to solve old debt problems no longer works without devaluing the currency itself. This is why people are once again turning their eyes toward real assets, things that can't be printed, manipulated, or devalued by a government's decision. And among those assets, gold and silver remain the most enduring symbols of safety. Now, the reason gold and silver matter so much today isn't simply because they've historically been valuable. It's because they are reflections of something even more fundamental: trust. When people lose faith in their governments, their currencies, or the promises that underpin the financial system, they look for value that exists beyond the reach of policy or politics. That's why, throughout history, every time we've seen major currency debasement or financial crisis, we've also seen renewed interest in gold and silver. We are in such a moment again. The combination of high inflation, rising interest rates, and growing geopolitical tension has created a level of global uncertainty that hasn't been seen since the 1970s. Central banks are tightening monetary policy to fight inflation, but they're also trapped because raising rates makes debt repayment harder and risks breaking the economy. On the other hand, printing more money to ease that pain only fuels inflation further. This is the dilemma of our time, the choice between economic pain now or systemic pain later. And as that uncertainty grows, investors begin seeking safety, not in paper promises, but in tangible value. Look around at the signs. Central banks across the world, especially in emerging economies, are buying record amounts of gold. They are diversifying away from the US dollar, which has been the world's dominant reserve currency for nearly 80 years. Why? Because they see what's coming. They see that the era of dollar dominance and endless liquidity is fading, and they're preparing for a world where power and trust are more fragmented. Gold and silver, therefore, are not just investments. They are insurance policies against the failure of the current system. But here's where the story becomes more complex. The shift we're witnessing is not just financial. It's geopolitical. The US, China, Europe, and many other major economies are caught in a cycle of strategic competition and internal instability. Wars, trade tensions, and sanctions are disrupting supply chains and global trade flows. These disruptions make the world less efficient. And when economies become less efficient, prices rise. Inflation becomes embedded in the system, not because of temporary factors, but because the world is moving away from cooperation toward fragmentation. In such an environment, assets like gold and silver become not just hedges against monetary inflation, but against political instability as well. The structural shift in the global economy also comes from demographics and technology. Aging populations in developed nations means slower growth and higher fiscal burdens. Governments must spend more on health care and pensions, which leads to larger deficits and more borrowing. At the same time, rapid technological change is reshaping industries, displacing workers, and creating new imbalances between productivity and wages. These trends, taken together, point to a world where inequality grows, political polarization deepens, and faith in institutions weakens. Exactly the kind of environment in which people begin to seek safety in physical, enduring value. All of this leads to a critical conclusion. The traditional definition of safe assets is changing. For much of the last 40 years, U.S. Treasury bonds were considered the ultimate safe haven. Investors believed that no matter what happened, the U.S. government would pay its debts. But when inflation runs high and real yields turn negative, meaning the return on bonds is less than the inflation rate, holding government debt no longer feels safe. It feels like a guaranteed loss of purchasing power. This is why the perception of safety is shifting back toward gold and silver, which don't depend on anyone's promise to retain their value. Let's also not ignore the psychological factor at play. In times of uncertainty, humans revert to what feels tangible. Gold and silver have survived every empire collapse, every market crash, and every monetary reset. They are universally recognized and trusted. That trust is what gives them their true value. So, as the financial landscape shifts and people realize that digital wealth and paper assets are only as strong as the systems that back them, the allure of precious metals grows. We're entering a period where volatility will become the new normal. Currencies will fluctuate, interest rates will move unpredictably, and geopolitical shocks will continue to shake markets. In such an environment, investors need to think differently, not just about profit, but about preservation. The goal isn't to chase the highest returns anymore, it's to maintain purchasing power and stability through turbulence. Gold and silver, for all their simplicity, fulfill that role better than most assets can. It's important to note that this transition won't happen overnight. Economic systems evolve slowly until they suddenly don't. Confidence erodes gradually and then all at once. The coming years, beginning in 2025, will test the resilience of our financial institutions, our currencies, and our assumptions about what is safe. The shifts in gold and silver prices that we're beginning to see aren't just market movements. They are signals, indicators that a deeper transformation is underway. The structural changes happening now, the persistence of inflation, the explosion of debt, and the fracturing of global cooperation are setting the stage for a revaluation of all forms of wealth. And in that process, the meaning of money itself will evolve as trust in fiat currencies weakens, as political and economic volatility rise, and as people seek security beyond digital and paper claims. Gold and silver will once again take their place as anchors of stability in an unstable world. This isn't about nostalgia or tradition. It's about recognizing the underlying forces that drive human behavior in uncertain times. People seek what endures, and gold and silver, unlike any other assets, have endured through every era of change. That is why the global financial landscape is shifting, because beneath all the charts and forecasts lies a simple truth. In a world built on confidence, when confidence fades, real value rises. Gold and silver have always carried a significance far deeper than their market prices or their industrial uses. They are not merely metals, they are mirrors reflecting the collective psychology of societies, economies, and empires. For thousands of years, gold and silver have represented trust, stability, and permanence in a world constantly shifting under the pressures of war, inflation, and political change. When people lose faith in governments or currencies, they instinctively turn to what has stood the test of time. These metals have become a language of confidence, a form of truth, in an era when promises and printed paper often fail to hold their meaning. When we say gold and silver reflect trust in governments, we are really talking about the foundation of modern economics: belief. Every piece of paper money, every digital number on a screen is built upon the collective belief that it holds value. But when that belief weakens, when inflation eats away at savings, and when political leaders make decisions that undermine economic stability, people begin searching for something that cannot be manipulated by policy or printed at will. Gold and silver become the fallback options, not out of nostalgia, but out of necessity. This phenomenon is not new. It has played out time and time again across centuries and continents. In ancient Rome, debasement of the denarius, the empire's currency, led to massive inflation, economic turmoil, and a loss of public confidence. Citizens began hoarding silver, melting down coins to preserve real value as the government diluted the metal content of money. Fast forward to 1920s Germany during the Weimar Republic, when hyperinflation destroyed the mark. People returned to gold, silver, and even barter because the national currency had lost all meaning. The same story repeated in Latin America, in post-war Europe, and even in more recent decades in countries like Venezuela and Turkey. The message through all these cases is clear: when faith in government controlled money erodes, people revert to timeless stores of value. In our modern world, where money exists largely in digital form, this relationship has become even more fragile. The more detached money becomes from anything physical, the more it depends entirely on trust. And that trust today is under pressure. The global economy runs on unprecedented debt. Sovereign, corporate, and consumer debt combined have reached levels never before seen in human history. Central banks have printed trillions in fiat currency over the last 2 decades to prop up economies, rescue markets, and fund governments. Yet, every printed dollar, euro, or yen reduces the purchasing power of all others already in circulation. The result is a silent erosion of value, a quiet tax on savers and workers who find that their income buys less and less each year. This is where gold and silver reclaim their importance. They are honest assets. They don't promise returns. They don't rely on governments or central banks to validate them. Their value is derived from scarcity, from the cost of extraction, and from thousands of years of human recognition. That's what makes them unique. They are not the product of anyone's policy, and therefore they can't be destroyed by policy failure. When people invest in gold and silver, they aren't merely speculating on price, they're making a statement about faith. It's a quiet form of protest, a way of saying, I don't fully trust the system. The recent rise in central bank gold purchases, especially by countries like China, India, and Russia, is proof of this shift. These nations are diversifying away from the US dollar, not just for economic reasons, but for strategic ones. The dollar has long represented the backbone of the global financial system, but it also represents dependence on US monetary policy in an era of geopolitical uncertainty. Holding gold means holding power that is beyond the reach of sanctions or politics. Silver, though often overlooked compared to gold, tells a parallel story. While it's an industrial metal used in electronics, solar panels, and medicine, it also plays a symbolic role similar to gold's as a store of value for the common person. Historically, silver was the people's money. While gold was hoarded by kingdoms and central banks, silver circulated among merchants, workers, and citizens. It has always represented economic freedom on a smaller scale. When governments lose control over their currencies, silver tends to outperform gold in percentage terms because of its smaller market size and higher volatility. That volatility, often seen as a risk, becomes a reward during monetary instability. Gold and silver prices, then, are not random. They are reflections of confidence, or the lack thereof, in the system. When inflation rises, when deficits expand, when wars break out, or when markets become unpredictable, these metals surge because they are not just reacting to economics, but to psychology. They measure fear and uncertainty just as much as they measure inflation and interest rates. It's also important to understand the cyclical nature of this trust. During times of economic stability and growth, people forget why gold and silver matter. They turn to equities, real estate, and digital assets for higher returns. The metals are dismissed as boring or outdated. But history shows that these periods of confidence never last forever. When the debt burden becomes too large, when markets correct, and when political promises can no longer be fulfilled, people rediscover why these ancient assets still hold relevance. That rediscovery is often abrupt, and when it happens, demand outpaces supply rapidly, leading to sudden, steep price surges. Gold and silver also serve as tools for understanding global power transitions. When a dominant empire or nation begins to decline economically, trust in its currency tends to weaken long before its power fully fades. This was true of the British pound in the early 20th century, and it's increasingly being discussed about the US dollar today. Gold flows toward emerging powers, signaling shifts in influence. The accumulation of gold by non-Western nations is not just financial diversification. It's preparation for a new monetary reality where multiple currencies compete and no single nation dictates the terms of global trade. At the personal level, gold and silver teach an even deeper lesson about perspective. They remind us that wealth is not merely about numbers on a screen, but about purchasing power and preservation. A single ounce of gold thousands of years ago could buy a fine suit of clothing. Today, that same ounce can still buy a fine suit. That continuity is extraordinary. It means that gold and silver preserve real value across generations, something no paper currency has ever achieved. In 2025, as inflation lingers and central banks struggle to balance debt and growth, the world is once again being forced to confront the limits of fiat money. People are beginning to question how sustainable a system built entirely on credit can be. Each new economic shock, whether from geopolitics, technology, or social unrest chips away at confidence in the abstract concept of money. And as that confidence erodes, the metals awaken. In that sense, gold and silver aren't just commodities, they are barometers of truth. They rise when illusions fade. They stand firm when promises crumble. They endure because they are rooted in something that can't be replicated. Human recognition of intrinsic worth. In every great turning point in history, from ancient empires to modern economies, the same cycle repeats. Faith rises, debt expands, trust breaks, and real value reemerges. So, when you see gold and silver gaining strength, don't just look at the charts. Look at what they're telling you. They're not predicting the future. They're revealing the present. A world where trust is fading and the search for real, tangible value is beginning again. The global economy operates on cycles, and one of the most powerful yet misunderstood cycles is the long-term monetary cycle. The rhythm through which debt, interest rates, money supply, and trust move together over decades. We are living through the late stage of one of these great cycles right now. The rules that once defined economic stability are breaking down, and the central banking system that has guided the world for over half a century is confronting its limits. The changing monetary environment, driven by decades of credit expansion, government deficits, and now rapid tightening, is about to redefine what assets hold real value and what assets are illusions. This change will not just shift markets, it will shift the very foundation of wealth and power across nations. To understand this, we need to look at how money and credit have interacted historically. Every economy moves through four key phases: debt accumulation, debt bubble, deleveraging, and restructuring. For the last 40 years, we have been in the debt accumulation and bubble phases, powered by artificially low interest rates and abundant credit. Central banks, led by the U.S. Federal Reserve, kept interest rates near zero for decades to encourage spending and investment. This worked for a time, creating growth and prosperity, but it also encouraged dependency on cheap money. Governments borrowed excessively, corporations leveraged their balance sheets, and individuals lived beyond their means, all under the assumption that money would remain cheap forever. However, debt doesn't disappear, it compounds, and as debt grows faster than income, servicing that debt becomes impossible without manipulating interest rates or expanding the money supply. This is exactly what happened over the past 2 decades. Whenever economic weakness appeared, central banks stepped in to print more money. Quantitative easing, stimulus checks, liquidity injections, each designed to delay pain and sustain the illusion of stability. But every rescue operation created even greater imbalances, inflating asset prices far beyond their real economic value. Stocks, real estate, and bonds all surged, not because of organic productivity, but because of the tidal wave of liquidity flooding the system. Now we've reached the tightening phase, a point where inflation has forced central banks to raise interest rates and withdraw liquidity. This is the most dangerous part of the cycle because the system has become addicted to easy money. Raising rates is like taking oxygen away from a patient on life support. Debt levels are so high that even small increases in interest rates create massive stress. Governments must pay more to service their debt. Corporations face higher borrowing costs, and consumers see their expenses rise while incomes stagnate. This creates a downward pressure on growth and a potential cascade of defaults. The illusion of stability built on credit begins to unravel. What we're witnessing now is not just a normal business cycle, it's the end of a long-term debt supercycle, process that happens roughly every 75 to 100 years. The last one ended in the 1940s after World War II, when nations were drowning in debt and the global monetary system had to be restructured. That restructuring gave birth to the Bretton Woods system in 1944, which pegged major currencies to the US dollar and the dollar itself to gold. For about 25 years, that system worked, until the early 1970s, when the United States could no longer maintain the dollar's convertibility to gold. In 1971, President Nixon closed the gold window, and from that point onward, money became entirely fiat, backed by nothing but trust. Since then, the world has lived through an era of extraordinary credit creation. The ability to create money out of thin air gave policymakers enormous power, but also removed all natural constraints. This created long periods of apparent prosperity, but also laid the groundwork for today's instability. Every major financial crisis since from the dot-com crash to the 2008 financial meltdown to the 2020 pandemic shock was met with more money printing, more debt, and lower rates. Each solution made the system more fragile, not more stable. And today, The bill for decades of excess is finally coming due. As central banks tighten policy to control inflation, they are discovering that they've reached a point of no return. They can't raise rates enough to kill inflation without causing a debt implosion, and they can't lower rates without reigniting inflation. This trap, known as stagflation, represents a structural shift in the monetary cycle. It's not temporary, it's the new reality. And in this new reality, the traditional playbook for wealth creation no longer works. Stocks and bonds, once considered reliable assets, are losing their protective qualities. The old 60-40 investment rule, 60% equities, 40% bonds, which worked for decades, is breaking down because both asset classes are now moving together, not opposite each other. When inflation rises, both suffer. When rates rise, both fall. This is where tangible assets like gold and silver come back into the picture. They are not bound by the same rules as paper assets because they are not liabilities. Every dollar, bond, or bank deposit is someone else's debt. But gold and silver are pure assets. They don't depend on the solvency of governments or corporations. In a tightening monetary environment, when liquidity is shrinking and confidence in paper wealth is fading, these metals gain in relative value. They become the anchor in a system drifting away from stability. Another aspect of this changing cycle is the global currency shift. For decades, the U.S. dollar has dominated trade, finance, and reserves. But every time debt cycles mature, the dominant currency of the previous order weakens. We saw this with the British pound after World War II, and now the dollar faces the same challenge. Nations like China, Russia, and members of the BRICS alliance are building alternative systems of trade settlement that bypass the dollar. Central banks in these countries are buying record quantities of gold as a hedge against dollar depreciation and as preparation for a potential shift in the global monetary order. This isn't speculation, it's a structural trend. The changing monetary cycle is also about psychology. For most of the last 40 years, people believed that central banks could control everything, inflation, recessions, even market crashes. That belief is fading. The realization that central banks are not omnipotent, that they cannot print trust, cannot erase debt without consequences, is one of the most important mental shifts of our era. Once that belief breaks, it changes how people, institutions, and nations behave. They start seeking safety in what is real, not what is promised. This transition from faith in paper wealth to faith in tangible value will define the coming years. What makes this moment unique is that the cycle is turning at a global scale. In the past, one country's monetary collapse could be isolated or contained. Today, because of globalization, the entire world economy is interconnected through debt markets, currency systems, and trade. A shock in one major region reverberates everywhere else. This means the next phase of the cycle, the restructuring phase, will likely involve a global reset of some form. It could mean new monetary alliances, partial return to commodity-backed currencies, or digital systems that integrate real assets, like gold into central bank frameworks. Whatever form it takes, the principle will be the same. The world will need to rebuild a system of money that restores trust. This is not a prediction of disaster. It's a recognition of natural economic evolution. Just as old systems decay when they reach their limits, new systems emerge from necessity. But transitions are never smooth. They come with volatility, loss, and opportunity. Those who understand the dynamics of this monetary cycle, who see the difference between nominal and real value, will be better prepared for what's coming. They won't cling to outdated assumptions about what constitutes safety or wealth. Instead, they'll focus on assets and strategies that align with the new era, one defined not by excess liquidity, but by scarcity, discipline, and real value. In this way, the changing monetary cycle is not just an economic event. It's a re-education in how value is perceived. It reminds us that money, in the end, is only as strong as the system that issues it, and that real wealth, as history consistently shows, lies in assets that endure when trust in that system begins to fade. September 2025 stands as more than just another point on the calendar. It represents a crucial turning point in the global financial system. It's the moment where years of monetary distortion, excessive debt, and geopolitical strain begin converging into a single reality that can no longer be ignored. Economies move slowly, almost imperceptibly, and then suddenly they shift all at once. That's the nature of inflection points. They arrive quietly after years of build-up and change everything in a matter of months. September 2025 could very well be remembered as the beginning of such a transition, a phase where paper wealth begins to lose its dominance and real tangible value reclaims its place at the center of finance. For decades, investors, policymakers, and ordinary citizens have operated under one grand assumption that governments and central banks could always manage crises by printing money or lowering interest rates. That faith worked as long as inflation stayed low and debt was manageable. But we've now reached the stage where those levers no longer produce stability. Instead, they amplify risk. Global debt has reached unsustainable levels, crossing over 350% of total world GDP. Central banks, once hailed as saviors during crises, are now trapped in an impossible dilemma: raise rates to fight inflation and risk collapsing the economy, or print more money to save markets and risk destroying the currency. Either path leads to a painful outcome. And in September 2025, this realization is beginning to take hold across the world's financial systems. This month could be the moment where confidence, the invisible glue that holds the monetary system together, starts to erode faster than before. Markets are already sensing that the era of free money is gone, and with it, the illusion of perpetual growth. We're witnessing the early stages of a liquidity contraction where capital becomes scarce, borrowing slows, and asset prices begin to correct to their true intrinsic values. When liquidity dries up, inflated valuations in stocks, real estate, and even government bonds start to deflate. That's not just a market event. It's a psychological one. For a generation of investors raised on the belief that central banks could always rescue them, this new reality feels like a shockwave. As liquidity tightens and trust in fiat currencies weakens, a silent migration begins from paper wealth to real assets. Historically, these transitions happen every few generations. They are moments when the financial world resets its definition of value. The last great revaluation occurred in the early 1970s when the U.S. detached the dollar from gold. That decision ushered in 5 decades of credit expansion, globalization, and asset inflation. But every system built on credit eventually hits its limit, and we are now arriving at that limit. The current financial structure, which depends on constant borrowing to sustain growth, can no longer expand without destabilizing itself. In this environment, gold and silver begin to behave differently, not as speculative instruments, but as refuges of trust. When everything built on promises starts to wobble, people instinctively turn to things that don't require anyone's guarantee. The value of gold and silver rises, not because they change, but because everything else does. They become the measuring stick against which the decline of currencies and the erosion of confidence are revealed. September 2025, then, may not simply be a month of price movements. It may be the beginning of a global repricing of value, one that acknowledges how distorted paper assets have become after years of artificial support. To understand why this moment is so critical. Look at the balance sheets of major economies. The United States, for instance, now carries a national debt exceeding 36 trillion. Interest payments alone are approaching unsustainable levels, soon to surpass military spending. The European Union faces similar problems as sluggish growth and aging population strain social welfare systems. Japan, once the model of monetary control, is now facing a currency crisis driven by decades of ultra-loose policy. Even emerging markets, once buoyed by cheap global liquidity, are suffering under the weight of a stronger dollar and rising borrowing costs. The pattern is clear. The world is entering a phase where the cost of money and the cost of maintaining the illusion of solvency is becoming unbearable. What happens when this cost becomes too high? Historically, the answer is always the same: a reset. Not a single announced event, but a gradual reordering of priorities, power, and perception. Nations begin to seek alternatives to the existing monetary order. We're already seeing this through the growing interest in gold-backed settlements, regional trade agreements that bypass the U.S. dollar, and the exploration of digital currencies tied to real assets. These developments are not isolated. They are signs of a system preparing for change, for the transition from a debt-based global economy to one grounded more firmly in tangible value. This transition will not be smooth. As liquidity tightens, volatility will rise. Markets will swing wildly as investors try to reposition for a world where inflation is persistent and growth is slowing. Traditional investment models, built on assumptions of low volatility and central bank support, will fail. Many financial institutions will struggle to adapt. Pension funds, insurance companies, and debt-heavy corporations could face solvency crises as the value of their holdings declines. Governments will respond with interventions, new regulations, capital controls, perhaps even wealth taxes, all aimed at containing the fallout. But such measures often accelerate, rather than prevent, the loss of confidence. For individuals and investors who understand the nature of this shift, the key is not fear, but preparation. The world is moving from an era of paper promises to one of real assets. Not just gold and silver, but land, commodities, and productive enterprises that hold value regardless of currency fluctuations. The distinction between nominal wealth, what's measured in dollars or euros, and real wealth, what retains purchasing power over time, will become clearer than ever. Those who adapt early, who understand that preservation is now more important than speculation, will be better positioned to thrive in the new era that follows. The lesson of every major economic transformation is that paper systems eventually give way to tangible realities. When governments overextend themselves, when debt outpaces production, when promises outweigh trust, the world resets. September 2025 may mark the visible beginning of that reset. The signs are everywhere: central banks diversifying reserves into gold, inflation proving stubborn, currencies losing credibility, and markets showing early signs of fragility. These are not random occurrences. They are the early tremors of a global rebalancing. And yet there is opportunity in this. Every transition, no matter how disruptive, creates space for innovation and renewal, just as the post-war period led to new global institutions, and the 1970s monetary shift led to financial globalization. This coming transformation will give rise to new systems that reflect the realities of the modern world. Digital, decentralized, and more closely tied to real value. But before the new order emerges, the old one must first be tested. That testing is what September 2025 represents, the moment when theory meets reality, when confidence meets consequence. The transition from paper to tangible wealth will not happen overnight, but it will begin here, in the recognition that the old tools of monetary control no longer work. The sooner individuals, institutions, and nations accept this truth, the smoother the adjustment can be. Those who cling to outdated models will face turbulence. Those who adapt will seize the advantage that comes only once in a generation, the chance to rebuild wealth on solid ground, not shifting sand. So, as we enter this pivotal moment, it's essential to think beyond prices, charts, or short-term forecasts. What matters now is understanding the direction of the tide. The global economy is pivoting from trust in paper to trust in proof, from promises to presence. And as history has shown again and again, when the world reaches this kind of turning point, real value, the kind that can't be printed, diluted, or defaulted on, always rises to the surface. In conclusion, the economic landscape of September 2025 is not simply about where gold and silver prices are headed. It's about what their movement represents in a world undergoing deep structural change. For decades, the global financial system has relied on artificial growth fueled by debt, low interest rates, and the unspoken belief that central banks could always prevent collapse. But that illusion is now dissolving. What we're witnessing is not a temporary cycle. It's a transformation. The tides of history are shifting from an era of paper promises to one of tangible value. Gold and silver are not just commodities in this moment. They are symbols of trust, independence, and financial truth. When confidence in fiat systems fades, people turn instinctively toward assets that cannot be printed, inflated, or defaulted upon. That's why the rise in precious metals is not speculative hype. It's a reflection of the growing recognition that real wealth must once again be built on real foundations. This shift will redefine what it means to be a rick or safe in the years ahead. We are entering a new economic cycle, one that will test institutions, challenge old beliefs, and force both investors and nations to rethink what value really is. The global monetary reset that's been quietly forming for years is now becoming visible. Debt-driven prosperity is being replaced by a demand for stability, productivity, and tangible worth. And as uncomfortable as this transition may be, it also holds extraordinary opportunity for those who understand the difference between illusion and reality. The next few years will separate those who adapt from those who deny, those who prepare. By diversifying into hard assets, by understanding the rhythm of debt cycles, by protecting purchasing power instead of chasing short-term gains, will emerge stronger. Those who continue to trust in the endless expansion of credit and paper wealth will find themselves unprepared for the new rules taking shape. So the message is clear. September 2025 is not the end. It's the beginning of a new era. An era where truth in value matters more than speculation, where preservation precedes profit, and where patience outperforms greed. The wise will see beyond the noise of daily price movements and recognize the deeper signal that history is resetting, and gold and silver are once again becoming the anchors of trust in an uncertain world. The choice before every investor, government, and citizen is simple but defining: cling to the old system of illusions or step forward into a world grounded in real, measurable worth. The future will belong to those who choose the latter, those who understand that while paper wealth can